Hello everybody, my name is Lesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending April 29th, 2022. Looking at the indexes for the week, the stock indexes were all down. Gold and oil, however, were up for the week. The S&P 500 is down 10% for the year, so in a correction, and the Nasdaq is down 18% for the year. We are seeing high market volatility in April, 3 times higher than the average for April. The volatility is expected to continue until inflation peaks. Oil is volatile in price because there's worry about demand as COVID spikes in China and there is less consumption. The US dollar has been getting stronger because it is considered safe, and the US Fed is raising interest rates just as well as Canada. Turning to the Canadian economy, the Bank of Canada forecasts that the Canadian economy will grow 4.25% this year before moderating to 3.25% in 2023 and 2.25% in 2024. In fact, the Canadian GDP increased 1.1% only for the month of February, which is quite significant. Before the pandemic, Canada's unemployment rate was 5.7. When the pandemic hit, it quickly soared to 13.4. And now, 2 years later, it is at a record low of 5.3. This is considered pretty much full employment. Looking at inflation in Canada, the Bank of Canada's latest outlook is for inflation to average almost 6% in the first half of 2022 and remain well above their 1 to 3% control range throughout this year. Then they expect it to ease to about 2.25% in the second half of 2023 before returning to the 2% target in 2024. Turning to interest rates in Canada, the Canadian Central Bank raised the policy interest rate 0.5% to 1%, still well below the neutral 2 weeks ago, in an effort to lower demand for goods and services in the economy. The bond market is showing expectations of Canadian Central Bank hiking 3 times 0.5% in early June, mid-July, and the September meetings, and one more hike by year-end, with May being 0.5% or possibly 0.75%, even though Tiff Macklem is saying that 0.75% hike in the next meeting is unlikely. The Canadian economy can take these rate hikes because of the strong GDP growth and high employment, although leverage and borrowing at the household and corporate level could mean things become difficult for Canadians. As of this week, the bank is no longer replacing maturing Government of Canada bonds with new ones, so the bank's balance sheet will shrink. This brings the bank's exceptional monetary policy response full circle. When the economy needed exceptional support in the depths of the recession, the bank lowered the policy to its lower bound and complemented this with quantitative easing, or QE. Last November, they ended QE and began reinvestment. The bank has now moved to quantitative tightening, or QT. With the economy fully recovered, it is time to normalize the balance sheet. QT will complement increases in the policy rate by putting upward pressure on longer-term interest rates, which will affect the fixed-rate mortgages. Turning now to market psychology, and the US Fed needs to appear hawkish, meaning they need to appear as raising interest rates significantly, and the demand will slow down in expectation of rising rates without actually increased rates. Inflation can be a self-fulfilling prophecy. It happens if people expect it, and doesn't if people think interest rates will increase. As companies prepare for inflation, they expect it and raise their own prices in preparation. Some experts believe we may have reached peak inflation level in the US, by the way. This past Monday, lockdowns in China are worrying markets about consumption, especially oil, as I mentioned earlier, as cases spread and new cities are being locked down. The lockdowns are also causing more supply issues of products coming from China. Interestingly enough, the Bank of China is easing interest rates. They are elsewhere in their business and economic cycle. Turning to the US, the US GDP made a surprising 1.4% annualized drop during the first quarter of 2022. This is the first negative since the first quarter of 2020 during COVID. The US economy, however, remains healthy. Business investment and consumer spending are doing just fine. The market, in fact, ignored the negative GDP because it was caused by heavy US imports, which will turn into local sales later. So this was basically caused by US consumerism. Also this past week, Amazon missed its numbers and its stock price got really beat up when it reported for its quarterly report. Turning to next week, the US Fed meeting is next week with a widely expected 0.5% rate hike to slow down demand in the US and slow down their economy, and as a result slow down inflation. A 0.75% hike is possible, but would be a bit of a surprise that would rattle the markets, since it generally harms the bottom line of most companies. Next week, the US earnings continue. On Tuesday, we have Pfizer, AMD, Starbucks, and Suncor. On Wednesday, we have in Canada the Great-West Life, Fortis, OpenText. On Thursday, Canadian Natural Resources, Shopify, BCE, Pembina Pipelines, Cameco, SNC-Lavalin, and on Friday we have Alibaba, TELUS, and Enbridge. Turning to economic events, on Monday we have the manufacturing PMI for April. On Wednesday, the US Fed interest rate decision is being revealed, and crude oil inventories are going to be told to us. On Thursday, the US jobless claims come out, and on Friday we have US payrolls and Canadian employment. That concludes my thoughts on the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.